Okay, let's continue along here and let's do another exercise, and let's take a look at another one of these modification of terms and think about it from the debtor and the creditor's perspective, how this would go. And let's take a look at exercise 26 and what is happening here with exercise 26. So on January 1st, 2013, Northfield becomes delinquent on a $100,000 14% note to First National Bank, on which $16,651 of accrued interest exists. So, right, basically our debt right now is $116,651, and the bank agrees to restructure the note, forgives the accrued interest, extends the repayment date to December 31st, and reduces the interest rate to 10%. And so the big question for us from the debtor's perspective, is this a gain or no gain situation? And so let's just kind of think about, our situation. This is exercise 26. So let's just draw a timeline. So currently we owe $116,651, right? And the bank agrees to restructure this by extending it 3 years, and we're going to lower the interest rate to 10%. So basically, under the new agreement, we're going to pay interest of $10,000 plus, right, $100,000 back at the very end. And so remember, with the restructuring, the first question that we ask, is this a gain or no gain situation? And in this situation, right, what we're thinking about is we're comparing the amount that we currently owe, $116,651, versus the undiscounted future cash flows. So it's $130. So we're going to still have to pay back more than we owe. And for this reason, this is a no gain situation. No gain. All right. And when there's a situation where there's not a gain, what we have to do is we have to calculate a new effective interest rate that is consistent with the $116,651 current present value. And so the way that we're going to do that is we're going to put n equals 3, because there's 3 more years. Payments equal negative 10,000. The future value equals negative 100,000. The present value equals 116,651, and we're going to solve for the interest rate per year. And let me just do that with my little calculator here. And right, just make sure that you put in the payment and the future value is negative and the present value is positive, and you come up with an interest rate per year of 4 or 4%, and that's going to be my new effective interest rate. So when we do this, we're not going to recognize any gain because we're still going to pay back more than we owe. However, right, what we're thinking about is we have a new amount of schedule. So what we're going to do here is we're going to recognize interest on this at December 31st, 2013. Remember, we're going to pay back cash, of $10,000. Remember, basically we have this payable. I'm going to combine them, and that payable is $116,651. That's what's currently on the books. So the $100,000 plus the $16,651, right? So we didn't recognize the gain. We didn't lower that amount, and the carrying value is only 116. So my interest expense is the 4% times the carrying value. So remember, it's the new effective rate times the carrying value, or 4% times 116,651. And that gives me $4,666. And the difference between those two is going to be the reduction of my interest payable, my payable. And I just, put it right there, and that is $5,334. So you can see what's happening here. With this new amortization, what I'm going to do is I'm going to drop this down to $1,111,317, and after these next two interest dates, the balance in this will be $100,000. So when the current liability is less than the future undiscounted cash flows, we will recognize a new effective interest rate, but no gain, and we'll just continue along there. All right. Let's take another one here in a situation that's a little bit different and see what we would do. Let's look at exercise 28. And this is a situation. It says for the creditor, and I'll get to that in a second, but let's just think about it from the debtor's perspective, exercise 1428. And in this situation, right, on December 31st, 2013, Central Bank agrees to a restructuring of 12% note with $200,000 face value and $60,000 of accrued interest. And, right, I'm going to first deal with it from the debtor's perspective. All right, so currently, right, we owe $260,000. That's my total amount owed. And I'm taking it from the perspective of Carter Company. And the bank agrees to forgive the accrued interest, extend the maturity date to December 31st, 2016, so 14, 15, 16, 3 years. All right. And reduce the interest rate to 6%. So they're still going to have to pay back the $200,000, but now it's going to be $12,000, $12,000, $12,000, 6%, right, is the new stated rate. And so from the debtor, right, the question is this a gain or no gain situation? And so you remember what we have to think about here is comparing the current liability, which is $260,000, and just remember that's the $200,000 that we owe plus the $60,000 of accrued interest, versus the undiscounted future cash flows. And in this case, right, it'd be the $12,000 plus $12,000 plus $12,000, $36,236. And so this is a gain situation. Gain situation. And the journal entry from the perspective of the debtor in this situation, right, is going to be just to reduce the liability by $24,000 and recognize a gain. So debit the liability, consolidate into a payable, debit $24,000 liability, and credit gain on modification, $24,000. So that difference is the gain. Now, let's take a look at this from the creditor's perspective. Right? From the creditor's perspective, a little bit different than that situation, because remember, this is one of those situations where the loan is going to be modified. We have to come up with a new amount receivable. And so here's it from the 1428 from the creditor's perspective. And again, right, we have an asset currently worth $260,000, right? That's what was currently on the books, right? And what we're going to receive is 12,000, 12,000, 12,000, and then 200,000. So we're in a loss situation because the future cash flows are less than the carrying value of the debt. And that loss equals the difference between the current carrying value of the liability and present value of the future cash flows, right? The discounted cash flows. So in this case, right, we have $260,000 minus, well, what is the present value today of this at the effective interest rate, at the old effective interest rate of 12%. And so what we'd want to do here to come up with the present value of those future cash flows is n equals 3, interest rate per year, right? You have to use the old effective interest rate. Even though you've modified the terms and lowered the stated rate to 6%, still use the old effective interest rate of 12%. The payments are negative 12,000, right? The future value is negative 200,000. And when I come up with the present value, when I do that calculation, let me 3n 12 interest rate, 12,000 negative is my payment, 200,000 negative is my future value, my present value, 171, 178. And we end up with a loss, then that loss equals 88,000 $88,822. And so what we would do in that situation is we're going to write down that asset. We're going to write off the interest receivable and write down the note receivable. And then, right, we're going to, and this is where it becomes a little bit trickier. Let's take a look at the debits and credits here. Let me add a blank slide. So on the date of the restructuring, December 31st, 2013, right, I'm going to recognize the loss. And my loss was 88,822. And right, I'm going to write up all that interest receivable, 60,000. Because remember, what was on the books at that time prior to that, we had a note receivable of 200,000, and we had interest receivable of 60,000. And so all the interest receivable is gone. That goes to zero. And now, right, basically this note receivable has a value of 178, which is the present value of the discounted cash flow. So note receivable, 28,822. All right. Now, here's the big part that makes this one really tough is that, remember, this note receivable in 3 years, how much are we going to receive from the debtor if everything goes according to plan? Well, $200,000. So when we amortize this, we have to get up to, oops, wrong side there. Sorry about that. When we amortize this, we're going to have to get up to $200,000. And so my journal entry on December 31st, 2014, when I received my first interest payment, I'm going to get cash of $12,000. My interest revenue, though, just like, remember, is always the effective rate times the carrying value. The effective rate is still 12%. The carrying value is 171, 178. 171, 178. Let me just erase that again. So interest revenue is the effective rate times carrying value. So 12% times 171, 178. And that's going to be 20,541. And the difference between those two is going to be my amortization to the note receivable. And that's going to be 8541. And as I do that, you can see what's going to happen here. I'm going to be increasing my asset until ultimately at the end of those 3 years, it has a value of $200,000. And that's how much I should receive on my final payment. All right, so that takes care of the modification of terms. It takes care of the settlement, and we've taken care of impairment. And so that ends Chapter 14, and we should be ready for the exam now as we go forward.